Is now starting. All attendees are in listen-only mode.
All right, welcome everyone to our last Title Topics webinar of 2017. These are Alta's free presentations that we offer on issues important to title professionals across the country. I am Jeremy Yohe, Alta's Vice President of Communications, and today we've got a great webinar lined up on that we hope will give you a solid understanding of what to expect from the housing market in 2018. A year that is really looking like we can expect to be dominated by purchase originations once again. And we kind of hold these forecast webinars each year, and over the past few years, there's always been some main topics that we're all looking to that we think are really going to affect the housing market. Past few years, we've had TRID, we've had discussion on how millennials will affect home buying, the presidential election, all things that have dominated the conversations that may influence origination volume, home sales. And now this year we've got the hot topics of tax reform and the ongoing struggle with housing inventory. So we'll get into the forecast here in just a few. First, I just need to touch on a few housekeeping items. I did email a copy of today's presentation to everyone who registered. You can also download a PDF from the handout section of the GoToWebinar window pane. If you're only listening by audio and you didn't happen to get the email that I sent earlier, you can shoot me an email at jyohe@alta.org. That's jyohe@alta.org, and I will send you a copy after we're done with the webinar. All participant lines are muted for today's presentation. If at any time you do have a question, submit them through the questions box. We'll hold a little bit of time at the end for Q&A. And as an added benefit, and let me check, yes, it is being recorded. We do record our webinars, and after a day or two, once we've edited the file, you'll get a link to access the recording. That way, if you miss any of today's presentation, or you think others on your staff would benefit from listening, you'll be able to provide that to them, as well as any customers that you may think this is helpful for them to hear as well. I need to thank Fidelity National Title Group for sponsoring our Title Topics webinars this year. Their support allows us to provide these educational opportunities free of charge. And with that out of the way, let me briefly introduce today's speaker. Joining us is Mark Fleming. Mark is Chief Economist for First American. Mark has frequently been quoted by national news outlets and industry trade publications such as the Wall Street Journal, New York Times, and Housing Wire. And he's been on several broadcast news channels in the past, and has also been a previous attendee of Alta One. So he definitely knows your business and is going to provide some great detail on the housing forecast and how that will affect your business going forward. So with that, Mark, I'll turn the presentation over to you.
Thank you, Jeremy, and thank you to Alta for inviting me to give the last presentation in 2017 and provide some forecasting on what might happen in 2018. Always a challenge for economists. Also, thank you to everyone who is attending the webinar today. I appreciate your taking the time to spend an hour with me so close to the end of the year. I know it's a very busy time, and I wish everybody happy holidays this year. Today we'll talk about forecasting the housing market. Really breaks down in my mind into really understanding, the age-old classic economic issues of demand and supply. And so we will talk about demand in the context of Generation Y, and then really focus a fair amount of conversation on the issues on the supply side relative to that demand. And we'll point out some of the differences we see today compared to times past. I'm also a big believer that history, while it never necessarily exactly repeats itself, can be very informative of the future. And that's very helpful in creating our forecasts for next year. It's also timely that we are doing this today because I'm based here in Washington, D.C., and just a few blocks away from me, the Federal Open Market Committee and the Fed are meeting, and in all likelihood, right as we wrap up this seminar today at 2 o'clock East Coast time, they will most likely be announcing another rate increase. And I will endeavor to explain why I don't really think the FOMC short-term federal fund rates increases are necessarily that important to us in the housing market. So that might be an interesting and timely thing when you're reading the news after you're done with me today. So let's get started. First of all, I really enjoy this quote from Mark Twain. It ain't what you don't know that gets you into trouble. It's what you know for sure that just ain't so. And I think a lot of what we know for sure that just ain't so is largely on the demand side of the housing market, specifically related to the behavior of millennials and our understanding of the trends in particularly highlighted, certainly in the press, highlighted statistics. The first example I have of that is the very simple one. This is the homeownership rate. Nice history back to 1965. And one asks the question, well, first of all, be careful in what you look at. Economists and data scientists in general, we like to play with numbers, and we can be somewhat deceiving sometimes. If you look at our y-axis, it only ranges from 62 to 70. So that's only 8 points of the entire scale. If I actually let this thing go from 0 to 70%, you would hardly be able to see much variation at all in the home ownership rate. So you really need to zoom in to understand that clearly for most of the 60s, 70s, 80s, and even up until the mid-90s, we hovered around a home ownership rate of about 64%, give or take. And in fact, even now that we're back at just below 64% today, it almost looks like the anomaly was 95 to 2014, right? And that we're not significantly below what would conceivably be a longer run trend in the home ownership rate. And so clearly something happened in 1995. There was sort of really a policy push that has been sustained through housing tax policy and through other means across administrations to really push the idea of homeownership. I firmly believe in homeownership as a significant and important linchpin of the American dream, and most importantly, it is the single largest source of wealth creation for most middle-class Americans. So homeownership is a really important construct. That said, probably the last 2% of that run up from 67 to 69%, we could argue might be due to, shall we kindly say, financial innovation in the housing finance system that probably shouldn't have been. And then, of course, we see the subsequent decline in the housing crisis and the Great Recession, back to 64%. And it is true when stated that the homeownership rate is at 50-year lows. That's a true statement. But again, a lot of that variation isn't in there. It is sort of down to a longer run trend that really didn't move that much prior to the first half of this century. More importantly, we really need to simply understand how the homeownership rate is constructed. And it's a very simple statistic. It is the number of owned households in the United States over the total number of households. So that is rented and owned. And so the homeownership rate can go down by either having fewer owned households, which maybe we contributed to a little bit through foreclosing people. Presumably a foreclosed home that household goes from being an owner household into most likely a renter household. So moving them from the numerator to the denominator as part of the rental household stock reduces the homeownership rate. But also more broadly, there is household formation in general in the United States over time. And we'll actually go to this guy to show that. And we're breaking down here the growth in households, or the amount of household formation over time in terms of a year-over-year growth rate for both rented and owned. And so anytime either the green or the blue line is above 0, you are on net increasing the total number of households that are either rented or owned. So you can clearly see since the Great Recession, and actually beginning a little bit before that, the rental household formation has been net positive and growing, while the blue line, owned household formation, has been generally net negative, only just very recently turning positive again. Real takeaway from this is that Since the end of the recession, we have added over 7 million new rental households, and we've actually lost about 1 million owned households. So for that reason alone, the home ownership rate will go down. So declining home ownership rates don't necessarily mean large amounts of fewer homeowners. It could just as easily mean a big increase in rental households instead. And that's actually what we've seen. These numbers are very volatile from the census, but you can see we've had a shift in the last year where now there seems to be a pretty consistent pattern to declining growth in the number of rental households and finally increasing growth in the amount of owned households in the US today, back to actually what we typically observed prior to the recession. And if I were to take this chart back, certainly through the 1990s. Really what drives household formation is demographics. So here I'm no longer being an economist as much as I am being a demographer. And the challenge is, or not really the challenge, the point that's being made here is a lot of these housing statistics that we look at are being driven in large part by the very big demographic changes that are afoot in our society today. In fact, we really think of ourselves demographically as a barbell. I'm generation X, and I really don't matter because my generation is relatively small. On either side of me are baby boomers who really drove a lot of home ownership, owned household formation, demand for owned households throughout the 80s and early 90s, followed by a smaller swing, and by the way, they were also demanding rental households prior to that, followed by a smaller generation X demand for housing. And now most recently, a lot of that green rental household formation is clearly millennials moving out of their proverbial parents' basements, or also most likely finishing up with college and moving on from college into rental households first prior to owning. So the real question becomes, what is the behavior of this very large cohort of millennials, and how might they be different from prior generations like Generation X and baby boomers before them? Now, first of all, I think we can all safely argue that typically the pattern that happens is when you form a household, well, maybe we should describe what forming a household actually means. If you are living with your parents, you're in your parents' household. If you're away at college, you're in a dormitory, most likely, or group housing as it's referred to, and that doesn't count as household formation. As soon as you finish college and move into an apartment with your friend or a roommate, you form a household. If you and your roommate get along for a while, and after a couple of years you've made some income gains, you want to strike out on your own and own your own apartment, then that creates two households. Well, one is lost and two are gained, so you're up plus one. And if you become a renter turning into an owner, you'll switch from green to blue, but you won't actually on net increase the total number of households in the country at a point in time. So what we're clearly seeing is that natural migration into renting first before buying. Now the question becomes, what have they been doing while they're renting or prior to renting, and why the potential delays in renting or household formation at all? So it's not uncommonly stated that millennials are going to school at a high rate. So in this chart, what we try to look at is the cumulative share of a generation that has attained a college degree or above, and how long it's taken that generation to do that. So starting with baby boomers. Baby boomers peaked at about 33%, where the blue lines flattened out, 33 to 34% of baby boomers acquire a bachelor's degree or higher, but that doesn't tail off until about the age of 45. What you see about Generation X is they got modestly higher attainment rate at just over 35%, but they did it much faster. That line is much higher, and basically by their early 30s, most everyone had attained a college degree. What we see with millennials is an even faster pace of educational attainment, and topping out what looks like roughly is going to be about 40%. So millennials are going to be a more educated generation than any generation before them, and they're achieving that educational attainment earlier on in their lives. Now, it's also important to note that one of the known facts about when people choose to work or get more education is largely driven by economic cycles. That is that when economic cycles turn for the worse, like a recession, generally people either stay in school or go back to school. So part of the rush to attainment of education is partly because if I'm a prospective senior in college in 2009, I might seriously consider going on for a master's degree rather than attempting to attain a job when the economy is shedding hundreds of thousands of jobs a month, right? So part of that real fast trend is is partly because of the economic recession and the timing of things. The other part of it too is that they're actually getting higher than a bachelor's degree more often than any other generation. And going to school takes, what this chart shows, is time. The other thing that going to school takes is, of course, money. And this is a conventional wisdom that is often stated that basically goes something like this in the popular press. We have more than $1 trillion of student loan debt. That's a true statement. And that means that they will never be able to buy a home. Well, I just don't see the link between having a lot of student loan debt and necessarily not ever being able to buy a home. Let's characterize it a little bit differently. When you go to try and figure out how much you can borrow to buy a home, the loan officer doesn't ask you how expensive is the car in your driveway or how much credit card debt you have. They ask you how much does it cost per month for you to be able to service the debt that you have for that expensive car and all of that credit card debt, or less if you don't have those things. And we're all trying to effectively figure out how much is left over after those obligations. Well, the same is true for student loan debt. It is just another one of those obligations that needs to be assessed. And so it's not the amount of student loan debt, it's how much per month relative to your income is the burden of paying that debt. Now, we've done a couple of things in the student loan marketplace. The green bars indicate the average repayment terms over time. So you can see we restructured the student loan marketplace to significantly increase the amount of time you can take to pay back a loan. Well, as everyone on this call I'm sure knows, the longer the term, the more you can borrow, holding the payment per month the same. Additionally, the student loan marketplace has benefited from a lower interest rate environment, just like mortgages. So we now have historically low student loan mortgage rates, again, increasing the amount you can borrow at a fixed monthly payment. And so the orange and blue lines show the average and median student loan payment to income ratio measured on the right-hand axis. And you can see that that burden of payment has actually come down significantly in average terms and remained very, very consistent for the last almost 20 years at just over 3% when using the median. So we can fairly characterize that while many students have more debt, one of the reasons they've attained that debt is because they get a better education. That allows them to get a better job with higher income, and they're effectively holding their burden in income percentage space roughly consistent. So the burden of student loan debt is not necessarily any more today than it was for my generation X and even some baby boomers, even though the amounts are much higher. So you ask the question, does that really hinder home ownership when 3% of your income doesn't necessarily isn't available for a mortgage instead? Maybe you have a little less credit card debt. Maybe you don't own a car. Common millennials own either less expensive cars or in many cases no cars. And so they don't have their payment for a car payment to make. And so maybe there's just as much money available, even though it's student loan instead of car debt, to make a mortgage payment. So if it's not that, then what might be driving it? Okay, this is my Rorschach test, and if you're on the West Coast listening to this, you might need a little more coffee. What we wanted to do in this chart is compare again each generation, but basically referenced to baby boomers. The ultimate goal is 12 o'clock home ownership, and against a bunch of different metrics that we think might be important to the decision to become a homeowner. Let's actually step back for a second. There are basically two economic schools of thought as to how people decide to be or demand home ownership. The first model, one that is probably the most commonly and widely used, goes something like this. Well, I need to compare the rent that I'm paying today to the conversion of the sale value of how much I would pay a home into basically a converted income stream. Well, that allows me to do I have to do a net present value calculation. I need to come up with a discount rate. Oh, but at least as it stands today, I get to do mortgage interest deduction, but I also need to pay for maintenance. What? Do we really think people think like that? Model number two goes something more like this, at least in my case, my wife told me to. In other words, the decision is driven by non-economic, non-financial factors, having kids and children, for example, and less so financial. In fact, really the way it goes is I make the decision to be a homeowner, and then I evaluate the financials in a second stage to determine how much home I can afford to buy. And so rather than not buying a home, I buy less home. Now, of course, on the margin, there is somebody who cannot afford to buy like the lowest priced home. Of course, that happens, but generally, that's how those economic models work. So back to the chart. What we see here is home ownership rate. Yep, anytime you're inside that blue line, you're proportionally doing worse than baby boomers when they were age 30 and each other generation at age 30. Anytime you're outside the line, 30-year-olds in that generation are doing better than 30-year-old baby boomers. So you can see on a home ownership rate perspective that Generation X and baby boomers had about the same home ownership rate by the age of 30. From an income perspective, you can clearly see that millennials were hampered relative to Generation X, but not necessarily more so than baby boomers, by the Great Recession. How many of them were employed? Again, a little bit more difficult for them than Generation X based upon the timing of the Great Recession, but certainly no worse than baby boomers. As I referenced before, going around the clock here, in terms of education, Generation X was significantly more educated than baby boomers, and millennials will be even more so. But when we get to the left-hand side, around sort of, 7 and 10 or 11 o'clock on this dial, you can see the lifestyle choices have secularly by generation been declining. In other words, 30-year-old Generation Xers are less likely to be married and less likely to have children at the age of 30, and millennials even more so less likely to be married and less likely to have children. Well, part of that is education takes time, and so that might delay those other decisions. And also it's important to note that this doesn't say anything about the willingness ultimately. I don't think anybody believes that, well, if Generation X is any proof, Generation X achieved the same marriage rate approximately and the same level of having children in their households as baby boomers did. They just did it by a later age. And the full expectation is that millennials will get married at the same rate and have children at the same rate as prior generations before them, but just at a later age. And so really what's driving things is these lifestyle decisions are holding millennials back from becoming homeowners. Why would I rush to the suburbs and buy a suburban home if I'm not yet married and don't have children? I'd much rather rent. I've spent all this time and energy getting an education. I'm trying to establish a career and figure out where that career might place me geographically before I own. All of those kinds of factors are really effectively delaying the decision for home ownership. They don't necessarily delay it permanently. The reason we know this is, first of all, understand that millennials, roughly aged 20 to 35, so you're talking about basically born between, 1980 and the early 2000s, or roughly about 2000. And so we've only just begun to see the oldest millennials sort of age into the sweet spot of home ownership, begin to get married, have children, make those decisions, and they're making it in droves at the moment. This chart shows the first-time homebuyer market share of government loans, Fannie, Freddie, FHA loans. Purchase origination. So you can see that more than half of all purchase originations, and certainly in the It spikes in the wintertime because because overall origination slowed down. But first-time home buyers basically are more than half of all purchase mortgages originated by government institutions, which happen to be the majority of the mortgage market today. So the millennial first-time buyer is here in the marketplace, and that demand for home ownership is only going to increase over the next 5 to 10 years. There's a huge pent-up, if you will, demand as those younger millennials continue to age into home ownership. They're just doing it at a later age than prior generations. I think the average age last time I checked was, I think, 32 or 33, according to the NAR, and that's up from the late 20s where it used to be. So we definitely are seeing this secular trend towards later, but not never, and that's an important point. So now let's switch our attention to the supply side of the market. So we can clearly establish that there's going to be plenty of demand for purchase originations. What are we going to do about supplying all of those sales? Well, let's first of all focus on negative equity, or the amount of equity. And that was clearly the problem coming out of the crisis. Lots of, I reported in reports when I, at my former employer about negative equity. Others still do report on negative equity, or the amount of equity that people have. And it was a big problem. Large amounts of homeowners, let's see if we can do this here. Basically, the blue line, under 95%, you account for transaction costs of selling of about 5 or 6%. Almost 40% of all home-owning households in the United States had less than 5% or were underwater on their homes, which meant that selling a home was an extremely difficult thing to do, because you would actually have to show up at the closing table with cash on hand or a check. And if you were significantly underwater, this could be a very big check for money that most households simply didn't have. So you were locked in to your existing home and unable to sell. It's also important to note that the home sales market is a little over 6 million homes a year. About 5.5 million of them are existing sales, meaning the other 500, 600,000 are new homes. Now, new homes don't have this problem. Presumably, most of the home builders that build a new home aren't in an underwater equity position. But the vast majority of the inventory supplied to the housing market for sale comes from existing homeowners who are facing these kinds of challenges. The good news when it comes to home equity is, of course, that it's gone down significantly. And we're now in a position where practically even over 90% of all households in the United States have at least 20% equity, largely because we've had a very fast rebound and very fast house price appreciation in practically every market across the country, and in many cases because of the lack of inventory. So if access to equity or the lack thereof is not the problem, what else might be the problem? So we look at what we refer to as the home ownership prisoner's dilemma. And this touches upon the fact that the vast majority of those sellers are also ultimately also buyers. And this is where the housing market significantly differs from most any other market. In economics, I was taught that you had the actor that was a supplier and the actor that was a demander. You know, Apple sells iPhones and Mark Fleming likes to buy iPhones. We're making independent decisions from each other to meet in the middle and set the price based upon supply and demand. The housing market doesn't work that way, because the existing homeowner or the supplier of housing inventory is also contemporaneously trying to make a demand decision. And also, unlike most markets like Apple iPhones, which is a homogeneous good, you know, this iPhone is exactly the same as that iPhone, there just have to be enough iPhones out there. Housing is not that way. Housing is what we refer to as a heterogeneous good. Every home is different. So the question becomes, if I'm going to sell, will I be able to find something that I like better than what I live in today to buy? Now, in a liquid market where there are lots of choices and lots of inventory, I trust that I'll be able to sell. And in my stylized market of two owners, One guy sells his home, the other guy buys a home, they both swap homes, and everybody's happy. Let's say each person preferred the other person's home. Net utility for all homeowners goes up, and everybody's happy. That would be a nice liquid market with lots of choices. The dilemma becomes, well, what if I fear not being able to buy something because I can't find something that I like? There's not a lot of inventory out there. The experience of getting into bidding wars for a home that isn't so good than the one I live in today isn't what I do. So owner 2 makes the decision not to sell at all. And so he's worse off. Owner 1 makes the decision to sell, but he's left with a tight inventory and an unpleasant experience and possibly a suboptimal home that he has to buy. So he's like, not so good. And the risk of doing that is too high. So the dilemma is this, what we refer to in economics as this non-cooperative outcome, is both owners choose not to sell. There is no sales, there is no inventory. And in fact, it exacerbates the problem, because if these owners all cooperated and brought their homes to market, there would be plenty of inventory to choose from. But the risk of being the first mover and the other guy not moving is too high, so everybody sits tight. That's the homeowner's prisoner's dilemma. Well, seems like a sensible idea possibly, or hopefully I explained it in a sensible enough way. But we decided to actually ask, and many of you on the call today may have actually received my request for you to participate in our Real Estate Sentiment Index survey. If you have, thank you very much for your participation. I hope that you will continue to participate, and I hope that you find that it's very quick and easy to do. That's my intent. If you haven't yet, I'd love for you to participate, and trust me, once you get the hang of it, it takes 3 or 4 minutes. We ask a very similar set of battery of questions around real estate sentiment that are very quick and easy, and we keep them the same. Every once in at the end of each one, we ask a special selection of questions. And a few quarters ago, we asked about this question: is in your home market, is there a shortage of inventory of homes for sale? First of all, 2/3 said yes, but interestingly, 1/3 said no. And so that really belies that real estate is local, and what we talk about at a national level in all these statistics and charts that I just show you doesn't necessarily have to be playing out in all markets in the United States. But for those who said that there was a shortage, they said it was moderate or high. Almost 80% said it was moderate or high. So there's clearly an issue of a lack of homes for sale in those markets where the inventory was short. And the primary reason for house price appreciation, yes, even if we don't have a lot of economic background, it's self-intuitive. If there's not a lot to buy, price goes up. That's what happens. The price is basically what tries to correct for this. But then the reasons why. We asked a bunch of different reasons, but interestingly, and thankfully our theory is confirmed, that almost half of all the respondents said it's because existing homeowners are worried that they will not be able to find something to buy. In other words, that fear of the prisoner's dilemma. The second most important one was first-time homebuyers' demand is absorbing a large share of available homes. Basically, we've got the homes, the liquidity seems to be there, but we're not able to keep up with the demand from those millennial first-time homebuyers. And the third one, existing homeowners' mortgage rate is lower than the current market rate. That's what we refer to as the lock-in effect, and I'll talk about that a little bit more. It's good to put this lock-in effect concept in context. If in 1981, you had bought a home, the prevailing 30-year fixed-rate mortgage was 18.1%. Now, what happened over the ensuing 30 years is a long-run tailwind trend of declining mortgage rates. So even if your house hasn't appreciated in value, but even though it most likely had, you would just be moving that equity to the next home. And even if your income had not risen between 1981 and say 83 or 84, the mortgage rate would have gone down by 4%. And so refinancing the mortgage balance would actually result in a lower monthly payment. Or maybe you could refinance into a slightly higher mortgage balance, get a little bit of cash out, make a home improvement, and keep your mortgage payment the same. A few years later, maybe just before, like in 88 or 89, well, now the mortgage rate's only 10%, and you could refinance again. Maybe reduce your mortgage payment, or take a little bit of cash out, or sell and move up, because all else equal, even if my income had not risen, I could now, at a 10% mortgage rate, afford to buy a bigger home, a more valuable home with a bigger mortgage, and hold my mortgage payment the same. And as you can see from this chart, that pattern continued to play out over the 90s, roughly held steady in the early 2000s, and then because of the quantitative easing and the reduction in rates and the Great Recession and all the stuff that the Federal Reserve is actually talking about, probably right now, went down even more to what are arguably historically low rates of around 4%. I think the last time we were actually in this kind of range of rate was in the 40s or 50s in the United States, and has actually been able to stay consistently around 4% for the last couple of years. What this drives is a significant amount of purchasing power on behalf of homeowners, or on behalf of anybody, because you can afford to borrow quite a lot of money at a fixed payment per month when the mortgage rate is so low. What we also know is that the vast majority of existing homeowners with mortgages today have basically locked into a 4% or even better mortgage rate. So what happens when the rates begin to rise? And here's a forecast for you. Mortgage rates will ultimately begin to rise, probably, well, they're already beginning to now, but certainly next year and into 2019. And so as those mortgage rates rise, effectively, if I were to move, I would have to pay more per month, because I'd lose my low 3.5 or 3 3/4 rate and pay 4.5 or a 5% rate. I would basically have to pay more for the privilege of borrowing the same amount as I had in my old home, which means if I want to keep my mortgage payment the same, I actually can only borrow less, and basically it costs me more per month to buy my own, I'm air quoting here, home back from myself. The bigger your loan, and obviously the higher the mortgage rate goes, the bigger that financial disincentive is. This is a financial disincentive that has been a financial incentive for the last 30 years, and we're about to turn the corner and turn it into a disincentive to sale. So all those existing homeowners will feel more like prisoners in their own home because of the rate lock-in effect. And well, even if we alleviate the supply, the prisoner's dilemma on fear of finding something to buy, create inventory shortages. We already see the beginnings of all of this happening today. This is the amount of active listings in market. You can see there's very, very few active listings in the inventory today. It's gone down dramatically. We're at below 1.6 million nationally, and you can see many, many markets have very, very low levels of inventory in their markets today. Practically everyone is low or tight. Okay, just a few more slides. We also see the beginnings of this binding in the amount of in the pace of sales, right? If no one's listing their homes for sale, ultimately maybe that we literally know you should get a reduction in the actual observed quantity of sales. The green line is what we refer to as our potential for the housing market. That is a function of economics and demographics and house prices and interest rates. That this is where we think the amount of sales activity should be. The green line indicates right now about 5.8 million. The blue line is the actual amount of existing home sales in the market, and we're at about 5.4 million today. And so that gap between green and blue is the shortage, or the falling short of potential in the market today. And we expect that that might certainly increase into 2018, because I don't see any particular dynamics that would change the ability for existing homeowners to want to bring more of their homes for sale to the market next year. So let's see. One way we can solve the problem is to physically increase the number of houses in the stock. So rather than focusing on the existing homeowner and his lack of desire to sell, let's just build more housing units. We've done that pretty effectively in response to all the rental demand of millennials. That's the blue line. It's back to relative norms of about 400,000 units a year. You can see the orange line, single-family housing starts, still well below historical normal average, which I would put somewhere a little bit above 1 million. and we're still falling short at about 8 million. And that has been going on with growing household formation, and the number of total households in the United States has increased, yet our ability to expand the stock of housing units has not kept up since the Great Recession. One of the challenges facing the home builders today is a lack of labor. And this is an industry that has lacked significant productivity growth. In fact, lower than even the low national level of productivity growth. Another way of saying it is we pretty much build homes the same way we did 30 or 40 years ago. One CEO of a publicly traded home builder was famously quoted as saying, I can put the fanciest nail gun in someone's hands, but they still need to be the one who figures out where to shoot the nail. And so there is potential or opportunity in the home building industry to come up with new ways to increase the productivity and be able to build more homes with less labor. I think that's a very important construct in being able to solve this shortage problem, because until then, it will be really hard to increase the amount of housing stock, residential construction labor growth. And let's go here. There you can see, green line is the 2-year smooth average demand. Blue line is the increase in supply. So anytime green is above blue, you're running a shortage or a deficit, and the total debt is the combined space between green and blue, which if you look since the end of the Great Recession, all of that gap added up is about 2.4 million housing units today. Well, one other possible way to fix the problem is that the existing homeowners could age out of homeownership. Here you see the homeownership rate by age category, and you can just begin to see that typically it's in the 70s where the homeownership rate begins to go down. And you can see, so that would be baby boomers aging out of homeownership into their last stage in life. The challenge here is that most baby boomers are healthier and wealthier than prior generations and able to basically stay in their own homes longer. So demographically, we actually expect that aging out process of homeownership to be pushed even further out in time. What does it mean for prices? I think this is important. We often say that home prices are losing affordability, are less affordable today than they were a year ago. I think that's a true statement, but they are not necessarily unaffordable. And the reason I say that is, let's break this down. Green line, indexed to 2000, is nominal house prices. That's starting at one. So basically, we're at almost double the price level today that we were in the year 2000. Gray line is income growth. And so house prices have significantly outpaced income growth. We're at about 145% or 45% higher level of income compared to 2000, even though house prices have doubled. And many say this is why housing is unaffordable. But when it comes to housing, it's not just your income, it's how much you can borrow by leveraging your income with an interest rate. And as I showed you earlier, interest rates have come down significantly. And so when you combine the borrowing power of income and falling interest rates, you get the blue line. This is purchasing power. Purchasing power is almost 2.5 times the level it was in the year 2000. Think of this as like a good form of inflation, right? In fact, it deflates house prices. And the blue bars is when we combine national house prices deflated by purchasing power. And you can see there that if you do it that way, because of the huge gains in purchasing power, house prices remain about 17% below where they were in even the year 2000 and well below the prior peak. This is why we like to say that house prices, yes, they have lost affordability in the last year as rates have risen and house prices have risen. They haven't been able to keep up with that, but they still remain highly affordable. When you break it out geographically, you can see any market in blue is below the year 2000 level, and any market in green is above. But even the ones in green are only modestly higher. And of course, those are the California markets, San Jose, LA, Orange County, San Francisco. But even those markets are only modestly above their year 2000 levels. The best way to describe it is the average income for a starting data scientist or computer science with a master's degree at Google in Silicon Valley is about $150,000. Keep in mind, I said your interest in buying a home is when you get married or partner up with somebody. So now you have a household with $250,000 earners. That's a $300,000 household at a mortgage rate of 4%. That means you can borrow roughly $1 million or even more than $1 million. Add to that $100,000 or $200,000 down payment, which is by far the hardest thing for a young couple to get together. And voila, you've bought your 900 square foot, 1 bedroom, 1 bathroom home in Cupertino. And with that, I'll end. This is where you can find me at First American's main website, my Twitter handle. And Jeremy, back to you.
All right, thanks, Mark. Great information on the housing market. A little scary if you're a prisoner in your own home. You better like the color of your walls, or go to Home Depot and buy some paint.
That's right. That's the beauty. If you're a homeowner, you can change the color.
You can't do that, yeah. As I mentioned earlier, we are going to hold some time here, about 10 minutes or so. We'll answer your questions. Just as a reminder, if you do have any, please submit them through the question box. And as some of these pop in, also a reminder, if you missed any parts of today's webinar, if you think others in your office would benefit from listening, a recording of the presentation will be emailed to you tomorrow. And you can also find an archive of all of our Title Topics webinars at alta.org/Title Topics. And Mark, you'd mentioned, you quoted the home builder who said, he can create a better nail gun, but he can't dictate, where they're going to fire that gun. Do you have any numbers as far as, where home starts are happening, where builders are, building homes?
Yeah, so the South and to a lesser extent, the West, Western regions are the primary places where the majority of home building is happening. Actually, Houston has been in the news because of Hurricane Harvey. Was not only is it one of the largest cities in the United States, but it was also one of the busiest expanding markets from a home building perspective when the hurricane hit. So there's lots of expansion in home building there. Interestingly, in part because it has one of the lowest regulatory regimes when it comes to building any kind of construction.
People still aren't. What's wrong with the Midwest? People still don't want to move here to, say Ohio.
Yeah, so that there is that challenge. I have to admit, Jeremy. Weather is an issue. People don't like the Northeast, where I am either, very much. But home builders are good. They're going to chase where jobs are. And so markets like Houston, for energy reasons, but other markets in the South like Atlanta, Charlotte, even Indianapolis and places like that are able to draw good employment opportunities to their markets and a low cost of living, and that's where people are choosing to move. And so home builders are building in response to that.
Okay. A couple of questions around first-time home buyers, millennials. Could you mention again that increase of the percentage of first-time home buyers that are millennials? Did you say over the next 5 years we'll see that to continue and rise? And what percentage will the millennials comprise of first-time home buyers?
Okay, so the percentage of first-time home buyers that are millennial will be the vast majority, right? By the time you get into your 40s or 50s, most 40 or 50-year-olds have already bought their home. Typically becoming a homeowner is something you typically do in your 30s. Obviously, people have economic issues and other reasons why that might be delayed further, but it really begins to tail off very quickly. So the majority of first-time home buyers will be millennials in the coming years. The exact percentages, a lot of that will actually, the percentage of home buyers that are first-time means now looking at sellers and rebuyers. Well, a lot of that has to do with this prisoner's dilemma concept. To what extent people all the existing homeowners choose not to sell. So the only people who are interested in purchasing a home, in other words, the purchase market becomes almost solely a first-time home buy market. I suppose it's possible that that's the case. I have argued that, if you're trying to figure out who your customer is, clearly your customer is going to be a young millennial household, more likely than not also a non-white household, which creates some interesting distinctions of how we deal with things going forward in our housing market. Because I don't expect very much refinance activity because of the rate, of interest rate incentives, obviously, nor due to these lock-in effects are all existing homeowners necessarily going to want to sell. Now, here's the caveat. The Nobel Prize winner in economics a couple of months ago this year, won his Nobel Prize, his name is Thaler, for largely being one of the primary inventors of what's referred to as behavioral economics. And behavioral economics really basically says all of that economic mumbo jumbo that is spouted by economists, assuming rational economic behavior on the part of individuals. So in this case, existing homeowners saying, well, it doesn't make any rational financial sense for me to sell, is bupkis. And that our behavior is often driven by many things, not necessarily economic. In other words, he was famously quoted as saying, we are more like Homer Simpson than we are like Spock. And so I also subscribe that many people will say, you know what, financially, the economic reason doesn't make sense, but I really like that home. I really want to buy that home over there. I really want the color on the walls or the extra bedroom that home has or the different layout. And so arguably, the financial brain is going to fight with the non-financial brain. Homer is going to fight with Spock to make these decisions, and I'm sure Homer will win, and people will sell, and inventory will be provided from existing homeowners. I don't know if it's more often than not, but it's not going to be always Spock winning the argument.
All right, nice Simpsons and Star Trek analogy.
That's the first time I've had a Simpsons analogy in an economic update, so there you go.
All right, Mark, a couple of, we'll see how you could tie this in here, Simpsons here, with tax reform. A few questions on what effect that could have on real estate. Obviously, we've had a lot of headlines as far as what Congress is doing to reform this area. Alta has been actively working with members of Congress to inform them of how certain changes could disrupt the sector. Specifically, both the House and Senate want to require people to own their homes longer before they can sell them without having to pay capital gains. And currently, they must live in their homes for 2 of the past 5 years in order to qualify, but they want to increase this to 5 of the past 8. So Alta has been, as I mentioned, actively advocating in this and warned Congress that limiting the capital gains exemption would severely disrupt the residential real estate industry.
Right.
So
this is important. Tying the Homer Spock analogy, in the context that we have to be cognizant of.
Sorry, Mark.
Jeremy, I'm sorry, but I think you're breaking up.
Oh, sorry. Am I still here?
Are you there?
Hello?
There we go.
All right.
There we go.
So,
we're back.
All right. Sorry about that. Maybe you got the crust of my question. So, you provide some great analysis for Alta that we've used to help highlight this concern. Could you kind of share that with everyone on the call on how limiting the capital gains exemption would affect home sales?
Right. So, using the Homer Spock analogy really quickly, a lot of it has to do with, is the Spock brain going to sort of analyze this purely financially? Or will Homer show up and you're going to make your decisions sort of regardless of what tax policy says is the correct thing to do? But I will say what we found, specifically with regard to the 2-year holding period versus, say, the 5-year holding period, is that there are really 2 kinds of buyers in the marketplace. When we look at our listings data, currently today, people actively listing their homes for sale. We went back and said, well, all of those people actively listing their homes for sale, how long have they lived in that home? What's their tenure length been? And we find the distribution has two lumps in it. There is a lump around 2 to 3 years. There's a whole cohort of individuals who've only lived in their homes for 2 or 3 years who are now actively selling. And so they're really kind of saying, well, I got to get past that current 2-year window so I don't have to pay taxes, because the capital gain tax is a pretty significant chunk of money. And I probably would prefer to move that into my next home than give it to the tax man. And so there's that chunk of, we'll refer them, those are the young buyers, the young families, that was their starter home and they're making that first move up. It takes a couple of homes before you get in the next one. And then it really tails off, and there are very few people who have tenure lengths of 5, 6, 7 years. It doesn't pick up again until active sellers today around 8, 9, 10, 11, 12 years. That's the long and hold buyer who I refer to. Is basically, you've moved into, those are people who moved into their home 10 years ago. They finished raising the family. They got the kids through high school. They sent them off to college. And now and only now am I choosing to move. And so your market is really comprised of really two fundamental types of buyers. Those who are young and early in their lives as families and households, and those who are more mature. And that dictates a lot of your likelihood of how long you would stay in a home. So moving that line to 5 really begins to change the calculation for those young, desirably more mobile households. And I don't know that what we're trying to protect is, flipping and other things. Our research also shows that, flipping happens all within the first year, 18 months. Most flippers aren't going to hold on to a home for 4 years with an intent to flip. So I get protecting against, this is a, exemption from capital gain is something we don't want a business of flipping homes to be able to take advantage of. They should probably pay taxes on that kind of stuff. 2 years seems like a pretty good mark to protect yourselves against that. Moving it to 5 would significantly increase the number of households, not business flippers inclusive, that would be impacted by this, and change the calculation. I think if I were a young household and knew that I might have to stay to avoid capital gains taxes for 5 years, that might want me to continue to rent. So there is some implication for a hit to home sales, which would mean a potential slowdown in house price appreciation, but not a decline in house price appreciation, or not a decline in house prices, just slower house price growth.
Okay.
I got Simpson in there too. There you go.
All right. We'll see. I'm not sure about hurricanes. So kind of a follow-up to the effect of hurricanes and where we're seeing new builds happening. Vanessa asked, if the recent hurricanes have affected the supply of home builders / contractors in unaffected areas, and do you have any data? Maybe has this resulted in higher construction prices in these other areas?
Yes, but modestly and localized. Houston has drawn construction labor away from other markets. Houston was already drawing construction labor away from other markets because it was so booming before. But even then, I think the more interesting dynamic is actually within Houston. What the hurricane has done has drawn construction labor away from home builders to residential homeowners. In other words, the desire to repair as opposed to build has created this whole new source of demand for all the rehabilitation work, which is making it all that much more difficult for Houston home builders. But there's very localized effects.
Okay, so not new builds, just rehabbing existing. Okay.
Rehabbing existing is now a source of competitive demand in Houston with new building in Houston.
Mm-hmm. You also mentioned, homeowners are gaining as home values increase. They're creating more equity. Do you expect to see, obviously, maybe a surge in HELOCs that the people on the call may start seeing?
Absolutely. If you have a mortgage, a 30-year fixed rate mortgage at 3 3/4, and you're sitting on a few $100,000 of equity, and you don't really want to move, how do I get that extra bedroom? I get a HELOC. I get the $50,000. I hire a contractor to add the addition. I get the new utility of that home, and I get to keep the majority of my housing debt at that low rate. Absolutely. HELOCs, even more so than home equity loans, HELOCs should become much increased in demand in the coming years.
Okay. All right. Thanks, Mark. I think that will kind of wrap up today's webinar. Looking ahead, our first webinar in 2018 will be looking at ways you can train your staff and help prepare them to operate more efficiently. So look for look for registration information for that here early in January. And with that, Mark, thanks again for breaking down all the housing stats and trends. It's always a pleasure to hear your insight.
Thank you, Jeremy, and happy holidays.
All right, and just to conclude, I'd also like to thank Fidelity once again for sponsoring today's webinar. Hope all the listeners found today's presentation useful. Take care, everyone.